Uber is a company that probably lost more money of existence than communism combined. I saw that you own the stock. It looked very interesting, and I bought a lot of it. So for us, it's a 4% position. This person probably put 1/3 of his net worth into the stock. When I started investing in the 90s, company trading at 20 times earnings was expensive. Today, after we had low interest rates for 20 years, now a lot of people who have not experienced high interest rates say, hey, this company only traded at 20 times earnings.
Vitaliy Katsenelson is the CEO and Chief Investment Officer of Investment Management Associates. He is a famed value investor and the author of several books, including his latest book, Solving the Game. In this interview, we dug into Vitaly's investment process, from the idea generation to valuation to position sizing to exiting the positions. But before we start, don't forget to subscribe. And now we start. Vitaliy, thank you very much for coming back to the podcast.
Asner, it's my pleasure. I've known you since you were a kid in college, and now you look at this grown man in front of me.
That's not how we start the conversation. You said that I'm losing hair and I have beard.
Well, I mean, you become a mature human being. Then that's what comes with maturity. You lose hair, and your beard goes gray. Welcome to manhood, I guess.
Oh yeah, thanks. So, I've read that you're a value investor.
You read it right.
What's value investing, and how has definition of value investing changed going from Ben Graham to today, if at all?
So value investing I would argue, it's a philosophy, or it's basically what investing is. In fact, maybe Warren Buffett would argue that the phrase value investing is redundant to some degree, but it's a basically commonsensical investing. Let me give you an example. Let's say you were going to go buy a gas station with your own money. The analysis you perform when you figure out if you want to buy the gas station would be how much traffic goes through this intersection, what the margins this gas station makes per gallon of gasoline, etc. Competition, but then you also look how much cash flow it generates, how sustainable these cash flows are, and then you can kind of try to figure out how much you want to pay for it, right? You may look at the multiple of price to cash flows, price to earnings, or you may do discounted cash flow analysis, and you would basically call it investing, right? And value investing is basically doing the same thing, but just in the stock market. Mm-hmm. So in other words, you are doing commonsensical analysis, and instead of treating stocks as just pieces of paper that happen to trade a million times a day, you look at stocks as businesses, as just thousands of gas stations, that across the world that you're looking at.
So if I look at this same example from a growth guy's perspective, I can say, well, I'm looking at this gas station, it generates cash, but this area is going to expand because there are like 100,000 new houses going to be built, right? I don't know, why can't I use this philosophy and that still would make sense for me to buy this gas station just based on that assumption?
I think there is a if you in this example, if you think there'll be huge growth in the area and the sales of this gas station will go up over a period of time, there is value in this, right? But let's say you're buying it when it has earnings of $1 million, and you think in 10 years it's going to have earnings of $5 million. That $4 million increase in earnings is very valuable. So, and this is where it gets tricky. In the stock market lingo, if you're buying the gas station whose earnings are growing maybe 5% a year, you're a value investor. If you're buying a gas station that's growing earnings grow from $1 million to $5 million, you become a growth investor. And I would argue both are investing and both are value investing, I would argue. Is just some people are more comfortable buying companies where there is a significant portion of value will be created in the future. And some people are less comfortable. There is another type of investor that would call growth investor, but they're not really being growth investors. They're really momentum investors. They're just buying stocks whose prices are going up. That's the momentum investing. And a lot of times they happen to be of companies that are growing earnings fast. These people pay very little attention actually a lot of times they pay no attention what the company even does, but they pay no attention how much they're paying for these earnings, etc. So one of our largest positions is Uber. And by the way, I'm a value investor. And Uber is a company that probably lost more money of existence than communism combined. And I still own the stock because in our analysis, we came to the conclusion that as Uber's revenues growth, keeps growing, it's going to become incredibly profitable. So I was willing to pay infinite price to earnings. If you look at the earnings when I was buying the stock, because it was not making any money, and I would argue I got a bargain because I was paying a very low price to future earnings.
Mm-hmm.
So we live in a world where everything has to be labeled, and value investing is a label, growth investing is a label, but really just commonsensical investing. If you're buying companies that are growing earnings and you've done the research, you're very comfortable in that this earnings is going to be much greater down the road, and that it's going to be very difficult for you to lose money because of how much you're paying for the stock, then you're a value investor. You just happen to buy a company that grow in earnings.
So what's the idea behind Uber suddenly becoming profitable? Is it like economies of scale?
Yeah, so Uber is a kind of company that is extremely misunderstood, especially like in the Silicon Valley. It's a company that's neither a digital company nor analog. It's kind of stuck in the middle. When I say digital company, let's say look at Facebook, right? Mm-hmm. When it's launched a website in the United States and it wanted to go to France, the cost of its going to France was minimal, right? They just had to translate the website to French. But so incremental cost of going from US market to another market was very, very low. Mm-hmm. Okay, because it's a digital company only. Uber is a hybrid. It's both analog and digital, meaning that it has the software. It's basically all it is, just connects drivers and passengers, right? People look at it as a technology company, it's a digital company, and that's true. But it's also an analog company because when it goes to Australia, for instance, it basically has to create a two-sided marketplace. Mm-hmm. So what Uber had to do in Australia, it had to pay drivers a lot of money to sit and do nothing while it went and got passengers. Mm-hmm. Okay. So when Uber went to new markets, the growth was very expensive because it had to build this two-sided marketplace. Plus, it had a lot of lawsuits from taxes, etc. So that growth was very expensive. Now, to make things even worse, there was a lot of other competitors. It was fighting for the market share. And it was doing it at the time when the capital was basically free. So for a long time, it was bleeding money just to maintain its market share. Now, when interest rates went up, when the capital actually, I think I would argue it was WeWork. When WeWork basically went almost belly up, right? The venture capital market woke up to the fact that companies maybe should become profitable. And the capital in the VC space dried up. And suddenly, which was great for Uber because they were the largest company in that space. They were in 50 countries at the time. And they were basically number one in almost every single market where they were. And so now the competitors became a lot more rational. So that was very good for Uber because now they didn't have to do irrational things anymore. So what's important about Uber is this: as its revenues are growing, so this duality of digital and analog, the byproduct of that is that it creates much higher fixed costs. Mm-hmm. However, once a company gets to scale, every incremental dollar of revenue, a very large portion of it drops to the bottom line. And this was our thesis when we bought Uber a few years ago. And we can clearly see this today, that as Uber's revenues are growing, it's become more and more profitable, and it's going to be gashing cash flows in a few years. Now, what's important to understand that the reason I feel very comfortable with Uber's growth, because I can see that it's a verb, actually. If you look at Uber, it's a verb already, right? It's a public service like utility. Mm-hmm. And you see a lot of people now, like we used to go to Florida, rent a car. Now we take Ubers. I have friends who used to have two cars. They sold one car, and whenever they need to, whenever they have a conflict, one of them takes Uber. So what Uber did, it created the market that did not exist before. And I would argue that market will be much larger 5 years from now than it is today.
It's got a little pricier though. I've noticed that.
I'm sorry, what's pricey?
The not a stock, but the actual services.
The price is set by supply and demand. What I love about Uber, it's a truly free market mechanism. If the price, the cost of taking Uber in Los Angeles is going to be very different than the cost in Omaha, and it's basically just driven by supply and demand. So if a lot more people like you think it's pricey and the demand declines, so will the price, right? Because so will the price, and then you're going to start taking Uber again.
What do you think about the management?
I think they've done overall a very good job. I'm not sure about their Postmates acquisition. I'm not sure if I think they probably overpaid for it dearly, but overall they've done a very good job. I think Dara did a very good job, kind of transitioning company from the culture that was necessary for it to become what it did to the next kind of to become a mature company at scale. I think the product innovation is very good. They keep coming up with new products. My daughter was had a sleepover at her cousin's house, and she forgot, like 10 o'clock at night, she realized she forgot her braces. I didn't want to drive 10 miles or 5 miles. So we literally called Uber. There was I forget, it was called Uber Connect or something, where basically driver comes in, picks up braces in in a little bag, brings it to our house 20 minutes later. And the whole thing cost me $10.
That's nice.
Yeah. So it's just another service. So I think they've been very innovative. I think Uber One is very important because I think it creates loyalty. Also, as I look at the company, what gives them a substantial competitive advantage is scale, because they can spread this R&D expense across 500 cities. The lessons they learn in one city, they can apply to another city. So it's so I think this is a company where the winner takes most. And by the way, to answer your question about the management, look where Lyft is today, where the business is versus Uber. Uber is doing much, much better than Lyft. Because I think it's because of management.
You typically don't discuss your investments. Why is that?
When I discuss investments, I usually want to teach people how to fish, not to provide them the fish. Because I think it's like when we talk about Uber, we're talking about a very, very large company. Okay, because I think there is a lot of lessons in sharing my analysis of Uber, because I think there's a lot of insights there. Now, one concern I have is that when I discuss investment, people just hear me talk about stock and go buy it without doing any research. My goal in life, I want to be net positive to society. And if somebody buys a stock and then it declines and they have done zero research, they have no idea if I still own the stock, if I already sold it. Also, I would argue there is a lot of value in doing research, because we bought Uber, our first position, a month before the pandemic. Except I did not know it was a month before the pandemic, right?
Yeah.
And then Uber declined probably 70%. We bought more when the stock declined. Okay, now the only reason we had the confidence to buy more, because we've done a tremendous amount of research. We had the models, we looked at the balance sheet, we had done a lot of work. If you bought the stock just because I bought it, you probably would do what most people would do in this situation. You probably would have panicked and sold it. Then after the pandemic, as the business started to improve, the stock actually declined. Like a year and a half ago, it declined again. We bought a lot more of it. Okay, again, just because we kept doing research, our understanding of the company got better. The true story, we run an investment firm, so we have to disclose our holdings in a form called 13F. Basically, any money manager who manages more than $100 million has to file this form for US listed stocks. So any of our foreign holdings, which about 1/3 of our assets, are not on this form. Okay. So first of all, number one, when people read this form, the positions appear larger than they really are because another big chunk of our portfolio is not disclosed. That's number one. So one time I had somebody kind of attack me on Twitter because one of the stocks that I never discussed in public, never, declined. And this person was very upset at me, and I couldn't understand why. Well, and then he told me, he said, listen, I saw that you own the stock. It looked very interesting, and I bought a lot of it. So for us, it's a 4% position. This person probably put 1/3 of his net worth into the stock. And now he's angry at me. And so I don't even know what to say in this situation, because what have I done to make him angry other than the fact that I followed the law and disclosed my holdings?
Just block him.
Yeah. So I think this is why whenever I discuss stocks, I try to do it very rarely, and I try to explain my thinking behind them. So I teach people how to analyze, and not really trying to tell them what to buy.
Yeah, and for people who are listening, there's going to be a disclaimer in the beginning that this is just opinion, so don't buy and don't attack Vitaliy on Twitter if something doesn't work out. Walk me through your investment process in general.
Well, let me sum up my process first. Buy the stocks that go up, and if they don't go up, don't buy them. That's, I think, Will Rogers said that. Somebody. Well, let's talk about our investment process. So finding new ideas is actually, there's a lot of randomness in that. All I try to do is systematize that randomness. I read a lot. I talk to other value investors. I look at the holdings of other investors I respect. And then after I look at their holdings and I see something I like, I go and do my own research. I just want to double click on this and stress it and underline it and highlight it. I look at ideas. I look for ideas, what other people own, but then we always do our own research. Like in investing, you have to be open to the fact that ideas don't come to you on Monday at 3:00 in the afternoon. Ideas come to you, and sometimes they come in 5 times. Sometimes they don't. You don't have a single good idea for months. You just have to be finding. You have to be patient. So that's how we look for ideas. We patiently just turn a lot of rocks. And then we basically, let's say we found a company that looks somewhat interesting. Then what we do is we see if you like the business. Does it have a good management? Does it have high recurrence of revenue? Does it have competitive advantages? Does it have a good balance sheet? And is the management, are they good at running the business? How they allocate capital? So also we have to, do they have good disclosures? So we kind of do this kind of research. Do we like the business? Then we ask ourselves, okay, well, how much is the business worth? And then we say, well, if it's worth 100 and it trades at 95, probably not a business we want to buy today. But if it trades worth, if you think it's worth 100 and today it trades at 50, yes, that's a business we want to own. And if by the way, it's 100 and trades at 95, we say, great, we're going to put it on our watch list because at some point it may it may trade at 50. But that's basically our research process. We would build financial models. We would stress test different assumptions. We would try to kill the business. And then when we don't kill it, then you become interested in that.
Let's dissect a few things there. Okay. So who are the investors you really admire, whom holdings you tend to look at?
It's kind of interesting. Like Seth Klarman, I have a tremendous admiration.
I don't understand his holdings. I don't know how.
That's exactly right. I look at his holdings and I kind of raise my hands and I say, I don't get it. That's exactly the point I was going to make. For instance, I have a tremendous admiration for Chuck Akre, and I look at his holdings all the time. I have a tremendous admiration, by the way, who is not I would argue he's a value investor, but none of his stocks would appear to be like traditional value stocks. I have a tremendous respect for David Einhorn, and I look at his holdings. whenever he buys something, I always look at it. Yeah, I always look at what he bought and why he bought it, because I think our investment styles overlap more with with Einhorn and with Klarman. We have a whole list of investors we go through, but those are the ones that come to mind right away.
And when you look at those holdings, do you look at the ones that kind of went down in price?
We do both. We look at them consistently every quarter.
Mm-hmm.
So the ones we're interested in the most are the new ones. But we also look at the if we see something decline in price a lot, we say, oh, this is interesting. Let's look at it too. It's a completely random. It's just, there's a saying, creating your own luck. Well, I think that's what we're doing, right? We just, if to create your own luck, you have to be doing things. You have to be turning a lot of rocks. I think I find that talking to other value investors is very helpful. Like I get a lot of ideas that way. And I, over the years, intentionally, I cultivated a network of other value investors I talk to all the time. And we even organize a conference in Vail every year just for that reason. So I can spend 3 days in the mountains, sharing ideas and talking to other value investors.
And how do you typically size the positions when you acquire companies?
It's really driven by two factors: company's quality and company's cheapness. Okay, let me give you two extremes.
Mm-hmm.
You have very low quality company and it's very expensive. You would argue probably should not own the stock, but on the let's put it on the spectrum.
Mm-hmm.
Okay, so it would be on the left, right? Like you probably own zero. Okay, on the other side, you're gonna have an incredibly high quality company and it's incredibly cheap. You should put arguably a lot more money into that, into that stock, right? So what we do, go through companies we analyze, and we assign a quality rating to each one of them, and then we quantify its cheapness. So companies that are the highest quality, higher quality, and the cheaper are larger positions. Companies that are relative to the other companies I just mentioned, lower quality, and maybe less in the value, there would be lower position sizes. So maybe the first company I mentioned would be 5% position. The second company, maybe 2% position.
How do you quantify the quality of the business?
So we have this framework where basically we break down the company into three kind of buckets, like analysis, into business, balance sheet, and management. And business, like I'm being repetitive a little bit, but in business, we would say, okay, is that a high quality business? So, high recurrence of revenue, significant competitive advantage, the traditional stuff, right? So that would be business analysis. Then balance sheet, does company have a lot of debt? Does have good balance sheet in relation to the stability of its cash flows? How much leverage does it have? Because we own companies. Some companies we own that have very little debt, and I would argue they're over-levered because their business is very volatile. And some other companies we own, like say cable companies, that have plenty of debt, and I would argue very conservatively financed because the cash flows are so stable.
Mm-hmm.
So then we look at management, and we try to quantify it. Are they, and we ask ourselves a question: are they good at running the business? Are they good at allocating capital? When we go through all this, and we quantify it, and we basically, for every company we have A, B, and C and D ratings. We own no D stocks. We own a few C stocks, and most of our stocks are A's and B's. And the only time we really own C stocks is it's a fallen angel. It used to be a B and became a C kind of thing.
When it comes to money allocation by management, how do you measure the effectiveness of that?
Well, we just look at the past decisions basically and see if it makes sense to us.
Do you look at the ROE or some other stuff, or not necessarily?
Well, we just basically say, let's say they bought a business and in the past, and we see how much they paid for it,
Mm-hmm.
and we see how much value they created from the business. Like that's if they bought back stock when it was making new highs.
Mm-hmm.
Well, and now when the stock is down, they don't want to buy it. Maybe the person that at the top was not the right decision. So you look at the rationality of the decisions, and you're trying to be vaguely right. And I think this is one lesson I learned in investing. One deceptive quality of doing research is that everything comes with a number attached to it, return on equity is going to be 16.55. Company is going to have 3.65 debt to equity, or whatever. So this precision often is misleading. So we try to, instead of doing our analysis with a very sharp pencil, we'd like to do it with crayon. So when a company, let's see, look at the company and you think it's $1, they're trading for 95 cents. Well, it's basically $1 trading for $1 in my mind. Okay. The whole idea of $1, it's a vague approximation. Just change a tiny assumption and suddenly become 95 cents. So this is why I want to buy it with I want to do my analysis with crayon. In fact, it's one thing we do, which I think is important. When we build financial models, we always start with what I call a tablecloth. It's a big model, which is very detailed. But then at the end, we need to shrink that model to a napkin. Meaning, if you really understand the business, then you can identify things that matter, and then you can basically build a company, the model with a crayon, as if you were writing out. If I could explain you a business and say why it's so cheap, and only had a napkin with me, then I could say, listen, this is a company that 5 years from now is going to have sales of $5 billion. It's going to generate this much cash flows, and we're only paying this much for that.
And how do you value businesses?
It depends, right? Ideally would like to do it on cash flows, but it depends. Like if it's a bank, you can't really value it on cash flows. Mm-hmm. You do it on the book value. It's a kind of valuation is a kind of art/science, and you need to know which when to use one method versus the other. Multiples are fine, except the problem is multiples. Like when you use price to earnings, price to cash flows, you get desensitized to them over time. When I started investing in the 90s, company trading at 20 times earnings was expensive. Today, after we had low interest rates for 20 years, now a lot of people who have not experienced high interest rates say, hey, this company only traded at 20 times earnings. This is why I would argue kind of going through discounted cash flow exercise is very important. I mean, every tool has advantages and disadvantages, and knowing what those advantages are is very important. Like discounted cash flows is a terrific tool, except extremely sensitive to the assumptions. I would argue it's very useful at the valuation extremes, meaning when some companies trade at such high valuation and you build discounted cash flow model for them, you realize they have to start going to the other side of the galaxies to those markets to justify the cash flows. Sometimes you just get discounted cash flow analysis in the company and you realize your assumptions are so conservative, it's very difficult to lose money because how cheap the company is. So this is, so we use multiple valuation tools, but it's just kind of trying to guesstimate what the company is worth.
Let's say you already bought the company and it's in your portfolio. At what point are you going to rebalance it to make sure that it doesn't grow to like higher than certain percent of the portfolio? Or not necessarily?
It depends if it's really grows a lot. Like McKesson went up so much for us, our largest position, that we had to keep trimming it because just at some point I think it became like 15% of the portfolio, so we had to keep reducing it. We try to do this, but not too much either, because like when we analyze McKesson today, and I think we were just doing analysis today, and we still get a 40. I could say it's a stock we bought for $140, and I think we still think it can generate maybe $40-50 of earnings a few years out with very conservative assumptions. Wow. So the stock price went up a lot, but it's actually still inexpensive in relation to where the stock price is today. Again, so should I be selling the stock? By the way, this is not a recommendation to buy McKesson. This is just kind of, I'm walking you through my thinking. So the stock price went, tripled, but earnings went up a lot more. So the stock price is still, the stock is still inexpensive. So we trimmed it because it's, it became just a very large portion of the portfolio, but it's still above average position for us.
When do you typically sell?
Well, you sell really just for 3 reasons. Or anybody should be selling for 3 reasons. The happy reason, when the stock price reached your valuation, target valuation level. When it became when you bought it for 50 cents, it became $1 basically. When you made a mistake, or it's actually mistake actually sounds mistakes makes it sound very negative, but when basically you had thesis when you bought this company, and life happened, and your thesis haven't worked out. Either you made a mistake in the beginning of analysis, or just literal life happened and certain risks showed up that that nobody could foresee, and then you thought it's worth $1, and now actually, but maybe it's worth only 60 cents, and you paid. If you're lucky, you paid 50 cents for it, so you haven't lost money. That's when you sell. Or when, let's say, it's that it's a proverbial dollar, and it's traded 80 cents, but you see a lot of opportunities, like, over now many other dollars where you can buy for 30 cents or 40 cents. So you're saying, okay, I'll sell this 80-cent dollar to buy a 30-cent dollar.
Mm-hmm. Have you ever bought a stock with a thesis that didn't work out, but you still made money?
Yeah. Oh, yes. It happens all the time.
And what do you do in that scenario? You just, when you realize that stock is going up not because of your thesis, but something else. What do you
usually
do?
Clients congratulate you on this, and you tell them, well,
that was
thank you, but I was wrong, which confuses my clients a lot. We are in the business where there's a lot of randomness. When you sell a stock and you made, either you made money or lost money, you want to look at your thesis and you want to see how it played out. If you were right for the right reasons or wrong reasons. So, the outcome is not always indicative of your process. I could be right for the right reasons or wrong reasons. So I just look back and just see if I can learn something from my past decisions. We tend to, and this is human nature, and I think you alluded to this, we tend to assign, when we make money, it's all because of our skill. And when we lose money, it's all because of bad luck. Well, if you are intellectually honest, it's kind of, we make money for wrong reasons, and sometimes we lose money for wrong reasons too.
So McKesson and Uber, obviously, the examples of big companies you own.
Yeah.
You also own smaller companies and international companies. Is the analysis the same, or there are some nuances?
There are some nuances, right? Like when we own small companies, and by the way, I never, ever, ever discuss small companies we own.
Mm-hmm.
And if I ever write about them, I always obfuscate the name. And there's a very good reason for that. I never want anybody to accuse me of trying to, because I'm read by a lot of people.
Mm-hmm.
I never want anybody to I never want anybody to think that I'm trying to pump stocks I write about. Okay, even have a perception of that. This is why I never mention, like small companies we own. You can find them on our 13Fs, but that's not, it's not by choice. So when you analyze small companies, you really care about liquidity. When you analyze foreign companies, it depends where they are. If they are in Europe, then the analysis is going to be very similar because we are a lot more culturally similar to Europe. If you analyze companies in Asia, very different culture. So you have to understand the nuances of Asian culture versus Western culture. Also, you have to be aware of currency risks. So we put hard limits on how much exposure to specific currency we have. Again, this is tricky discussion again, because I can own an American company that has all its sales come from outside of the United States.
Mm-hmm.
Or I can have a foreign company that happens to be, like, I'll give you an example. We own Philip Morris International, which is an American company, but all of its sales come from outside of the United States. Philip Morris used to be an American company, and then it got split up. Altria became Marlboro, sales in the United States, and Philip Morris International became Marlboro sales outside of the United States. So you want to be mindful about this kind of details. But overall, like 95% of the analysis is going to be the same. And then maybe on the margins, you're going to have some nuances because companies listed somewhere else, or because of the small company, you want to make sure, you have to modify your analysis a little bit.
Buffett always emphasizes that he doesn't look at the macro. Do value investors look at macro, and do you look at macro? And has anything changed about it?
I think that statement in itself is incorrect a little bit. I think it's a little bit misunderstood because Buffett does look at macro. What he doesn't do, he doesn't care where the interest rates are going to be or what the Fed decision is going to be next month. I know, and I can prove that he looks at macro because he wrote a Fortune magazine article like in late '90s, talking about the Dow is overpriced. Okay, so he does look at macro. He just, instead of paying attention to weather, which a lot of which changes every single day and consumes a huge amount of energy. If you are a long-term investor and you spend all your time paying attention to if it's going to be sunny tomorrow, it's going to rain, he's paying attention to kind of climate changing events. And I would argue, as an investor, you have to do this because your companies don't live in a theoretical vacuum. They live in the macro economy. And if you think interest rates will go up a lot for a long period of time, or if you think there's going to be inflation, you probably want to make sure that your portfolio can withstand that. So understanding macro environment is basically kind of understanding the terrain you're investing in. So I keep hearing that Buffett doesn't care about macro, and I don't know where that idea came from, but
from people like me, probably.
No, I think, but I think it's just I think it came from the statements when he said that he doesn't care what the Fed is going to do tomorrow.
Looking at macro, but not making bets based on that. Is it fair to say that?
It's not quite true.
You keep proving me wrong. Okay, tell me.
No. It's a nuance point. Looking at macro, but not in the very short term time frame, but in a long term time frame. Because in the short term time frame, it's very difficult to have any insights, and it consumes a huge amount of energy for a payoff that is very short term in nature by definition. Looking at macro and identifying climate changing events where things may change tremendously, and then making adjustments to your portfolio that consumes a lot less energy. And that's the analysis you can do with Crayon. And I would argue will have a much higher return on your investment, meaning time.
You obviously go to Berkshire ahead of a meeting, and many famous hedge fund managers and investment managers go there. I'm curious, why not more of them try to mimic what Buffett does, which is buy an operating company because they can afford it technically and invest cash flow over that company?
Well, a lot of them have tried that and failed miserably because what Buffett has done, and probably thanks to DJ, he also created an incredible insurance company, and he does it inside an insurance company. And I think I think David Einhorn tried it. Third Point Capital guy tried it, and it's a very difficult to have a very good insurance business. And I think so. This is why a lot of them have failed at that. So, I mean, I think that's would be the reason for that.
Soul in the Game. This is your first non-investment book, right? Why did you write it, and what is it about?
It's a book that I felt like I had to write. I had to write because my kids don't read my emails. And I figured that the only way they would read my life essays about life if I basically put them into a book. And that's, by the way, that's exactly how I got them to read my life essays. But I think this is a book, like when you have an investment guy write a book about life, people are usually very skeptical about it. And as they should be, right? Because just because you achieve some kind of financial success or whatever, doesn't mean you know anything about life. And I completely agree with that sentiment. But this is my book where I try to, as a human being, in addition to being an investment guy, I'm a human being who goes through life and try to understand it. This is my exploration of, kind of trying to understand life. And I don't think it's very prescriptive. I think this is just me going through life and said, this is what I learned. And I think that may help you or may not, but this is what I think about it. So that's my book, Soul in the Game.
So when you were writing it, did you have your kids as a primary audience?
I mean, I was writing it for, my intention was I really wanted my kids to read it. Okay. But obviously, I didn't have to publish it if I wanted my kids to read it, But I just felt like this is a book where I can make a. I mean, I may manage about $450 million. We have about 330 clients. So I feel we make a substantial difference to our clients. But that's only 330 individuals. With this book, I felt like I could help a lot more people with things I learned over the years about life.
And outside of life, you have only 330, not only, but 330 clients whose money you can invest. For other people, would you recommend them to practice value investing, or would you recommend them to just invest in an index and just focus on whatever they do day to day?
This is so difficult because I have a friend who came to us just with $10,000, and I, honest to God, I could not figure, like, we couldn't help her because it's just too little money. We couldn't even build a portfolio with this little money, and I struggled to come up with a solution. I honestly did, because I would argue the index funds are the worst place to be today. Absolutely, and because the market is extremely expensive. And I would argue if you buy index funds today, kind of broad market index funds, you're probably not going to make much money for the next 10 or 15 years. But